Welcome everybody to episode number 5 of EU Unpacked. I'm Karl Thies. I'm working at Freshfields EU Regulatory and Public Affairs Practice in Brussels, and I'm your host for today. Today, we are diving into a topic that is generating a lot of conversation in policy circles and increasingly in boardrooms across Europe. We are talking about the revision of the EU emission trading system, the ETS. We will discuss what the Commission's proposal is expected to look like and what it means for businesses. Joining me today are two Freshfields partners who work on this day in and day out. James Chapman is tuning in from London and Stefan Schröder is tuning in from Düsseldorf. James, Stefan, could you give our listeners an idea of how the ETS is featuring in your daily work?
Thanks very much, Karl. So I come at this topic from a transactional perspective, looking at how it impacts emitters and investors. My practice focuses on product development and financing, and I've worked on a wide range of energy and infrastructure projects across the globe during my career. But these days, I spend most of my time helping companies and investors set up projects and value chains in the low carbon space, and in particular in carbon capture.
Hi, Karl. I'm an energy regulatory and energy commercial lawyer, but because of the close connection between the energy sector and emissions trading, the EU ETS has been a core part of my practice for many years. I'm advising also energy intensive companies and also utilities on their compliance strategies. And clearly, as the ETS rules tighten and free allocations are restructured, we are seeing a significant rise in carbon related matters.
Brilliant. Very good to have you both. To start with the basics, the EU ETS has now been running for 20 years. During that period, it has reduced covered emissions by about 50%. The ETS covers power and heat generation, energy-intensive industries, aviation, and maritime transport. I think we can without any doubt say that the EU ETS is the EU's most important climate policy, and it has direct business impact. The revision we are talking about today was actually scheduled, to be clear. The directive that was revised in 2023 had already several review clauses introduced. So this is not just a sudden political reaction to put the ETS back on the legislative radar. However, it comes at a time when the political climate has shifted. I think what we clearly see during this Commission mandate is that the focus is much more on competitiveness than it was during the previous mandate. The Commission's proposal is expected on 15th July. This is in a few weeks. After the publication, the proposal will go through the EU's ordinary legislative procedure. That means that both the European Parliament and the member states will have to agree on a text. The target to reach an agreement is early 2027. This is very ambitious, but let's see. But before we go into the technical details, James, you are speaking to industry clients every day. What are you actually hearing from them about this revision?
So clients are very aware of the business impact of the EU ETS and the upcoming changes. And that awareness has really sharpened as this revision has moved up the political agenda. What we're hearing at the moment is not just concern about costs in the near term, but something much more fundamental for most of our clients, which is longer term uncertainty. Businesses need to plan around a carbon price and they want to know what to expect from the regime. What's hard to plan around is not just uncertainty about the price, which is an inherent part of the regulatory scheme, but not even knowing what the rules are going to look like in 5, 10 years' time. And that uncertainty looks particularly acute for businesses with long-lived capital assets, as is the case for most of our industrial clients: steel plants, cement facilities, chemical complexes. These investment decisions are not ones that you can easily reverse. You're potentially making investment choices today with maybe 30, 40-year time horizons that get materially affected by an ETS that doesn't exist in its current form by the end of that period. So the question clients are really asking is, how do I make a sound investment decision now when the policy framework I'm investing against is still being written?
Let's move on to the regulatory mechanics because this is what will actually govern business decisions in the end. There are a lot of moving parts here, so let's take one at a time. Let us start with the linear reduction factor, the LRF, because this is foundational to the level of ambition of the ETS.
Yeah, that's right. The LRF is the annual percentage by which the total cap on available emission allowances declines each year. The higher the LRF, the faster the allowance becomes scarce and the stronger the incentive to decarbonize. So currently it is set at a rate designed to align with the EU's 2030 climate target. However, in March this year, the EU institutions adopted a revised climate law, and this is where it gets relevant for the revision. The law sets a new 2040 target requiring a 90% reduction in emissions compared to 1990 levels. 85% must be achieved through domestic action. This is slightly less ambitious than initially expected. And the Commission has also indicated that it gives it the basis to lower the pace of reduction. In other words, to reduce the RLF, which you just mentioned. And that is of enormous relevance in practice. As the ETS stands right now, the number of available emissions allowances would approach zero around 2040. This would mean that any business that has not fully decarbonized by that point simply could not operate. There would be no allowances left to cover their emissions.
And there is a related piece here, right? The market stability reserve. Stefan, can you explain to us what this is and why it is also being reformed?
Yeah, sure, of course. So the market stability reserves, the MSR, is essentially the ETS built-in stabilization mechanism. It automatically removes allowances from the market when the number exceeds a certain threshold and releases them back when the market gets tight. So the idea is to prevent extreme price peaks. Now, there's already a specific proposal on the table, published in April this year, that addresses one particular feature of the MSR. The proposal was a direct reaction to the current energy crisis. Under the current system, all allowances held in the reserve above 400 million are automatically permanently removed from the market. The proposed amendment would stop that invalidation mechanism, allowing those allowances to be retained as a future buffer. Next to this short-term stage, the revision will also look at the broader design of the MSR.
So the LRF sets the pace and the MSR manages supply shocks. Now, a big part of the current system is also free allocation, which means giving allowances to businesses that they don't have to purchase. Stefan, how is this going to change?
So the background of this is that free allocations are EU ETS allowances granted at no cost to industrial operators to avoid the so-called carbon leakage. The idea is to avoid that European industry simply shifts production and emissions elsewhere to avoid carbon costs. Therefore, certain operators receive a number of allowances free of charge, calculated against product benchmarks. In practice, this means sectors at high carbon leakage risk receive 100% of their benchmark allocation, while others receive proportionally less. With the review, the Commission is repositioning free allocations as a dual-purpose instrument, retaining their leakage protection function, but increasingly tying them to decarbonization investments. Beyond 2030, this might be formalized through strengthened investment-linked conditionality. So the allocation comes with more strings attached, but free allocation will definitely continue after 2030. And for sectors covered by the Carbon Border Adjustment Mechanism, the CBAM, such as steel, cement, and aluminum, free allocations are to be fully phased out by 2034, with CBAM taking over the carbon leakage protection function. However, the Commission sees remaining carbon leakage risks and want to address those within the EU ETS revision.
James, listening to what Stefan just outlined, it seems like the level of ambition may be lower after the revision. But if I understand correctly, this is not necessarily good news for businesses, right?
Well, it really depends on the industry and the company, and that's what makes this revision so complex to navigate. As you've already covered, the EU ETS covers a large range of sectors and business models, and they're not all in the same position. You've got some companies who have already made significant investments to decarbonize well ahead of that 2040 horizon. And so for them, a high and rising carbon price isn't a threat at all. It's a competitive advantage relative to the other companies in their sectors. They've taken the risk, they've made the capital commitments, both on their own asset base, but also investing in transport and processing infrastructure that you need for these value chains. Now, these early movers are really counting on the policy framework to reward that early move. If the ambition is lowered and the carbon price softens, that calculation looks rather different. But on the other hand, for sectors where decarbonisation is more technically or economically challenging, lots of parts of heavy industry, for example, a little more time is not unwelcome. Technology may not yet be available at scale. The infrastructure ecosystem is certainly not sufficiently well developed. Or alternatively, the investment required is just not financeable under current conditions. So for companies in those sorts of situations, a much more gradual trajectory is just a pragmatic recognition of reality. And you've got some companies even calling for freezing the EU ETS. So there's no single answer. What the revision does is essentially redistribute the pressure. And depending on where you sit, that can look very different.
That's really fascinating. So I think we can assume that the stakeholder landscape, the economic stakeholder landscape, is actually going to be more or less split over this proposal. Stefan, there are two more technical elements that are really important. carbon removals and international carbon credits. Carbon removals are completely new territory for the ETS. What is on the table?
Yeah, that is indeed completely new territory. So if you look into the past, the ETS has always been built around emissions. You emit, you surrender allowances for it. What is now being considered is whether CO2 that has been permanently removed from the atmosphere can be integrated into that same compliance frame. So in other words, could a verified removal effectively cancel out an emission within the ETS itself? Several design options are being explored, and the policy rationale is clear: to start building and scaling a carbon removal market in Europe. This is particularly relevant for hard-to-abate sectors, so industries where some level of residual emissions will remain into the 2040s and beyond, simply because the technology to eliminate them entirely does not yet exist at a commercial scale. The idea is that if those residual emissions cannot be avoided, they should at least be able to be counterbalanced by verified permanent removals. So in that sense, the mechanism is conceptually similar to carbon offsetting through voluntary carbon credits, which many companies have used in the market for many years.
And that's something that's really relevant for a lot of businesses. For lots of our clients in hard to abate sectors, full decarbonisation by any near term deadline is just not realistic. With currently available technology and infrastructure, there will be residual emissions that can't be engineered away, certainly not within the timeframes we're talking about. So the question for these clients is, what do you do with those? If carbon removals can be integrated into the EU ETS compliance framework, it opens up a really interesting pathway that did not previously exist. Instead of facing a compliance cliff edge, companies can potentially offset those residual emissions against verified removals, whether that's geological storage, bioenergy with carbon capture, or any other certified approach. It's another way to make sure these industries can continue operating in the EU for the next few decades.
And what about international carbon credits then? That has been one of the most contested questions in the stakeholder process, right?
Yeah, it has. The short answer is that the Commission does not really want international credits to function as a direct compliance instrument within the ETS. Companies will not be able to purchase credits from, let's say, a forestry project in South America and use them to cover their ETS obligations directly. What is being proposed is more indirect. According to the revised EU climate law, up to 5% of the 90% 2040 target could be addressed through internationally purchased credits. This creates more space for domestic emissions. With this approach, the integrity of the ETS as a domestic instrument would be preserved while still allowing some degree of flexibility at the overall economy level.
Stefan, now one more area, scope extensions. Are there any new sectors coming into the EU ETS?
Yeah, I think that's likely. The Commission is actively looking at several sectors. So, waste incineration is being examined as a potential extension, which could lead to surrendering requirements as early as 2028, though many stakeholders are pushing for a post 2030 timeline. The assessment is complicated here. Incineration facilities have limited control over their emissions and would depend significantly on the availability of carbon capture infrastructure to decarbonize. Also, smaller maritime vessels are under review. Larger ships were brought into the ETS within the last review, and the question is now whether the coverage should be extended further down the fleet. And then there's also international aviation, flights departing from the EEA to third countries. That one is more politically sensitive, and it depends partly on how CORSIA, the international aviation offsetting mechanism, is assessed for environmental integrity. If CORSIA is deemed sufficiently robust, it may be treated as an acceptable alternative to full ETS coverage for those routes. If not, my expectation is that the Commission would extend the ETS coverage.
James, how do you think this will end, the extension to non-EU flights?
As Stefan said, it's pretty sensitive, and it's another potential point of friction between the EU and non EU countries. The US, as an example. If you look at how the US administration has been defending American business interests across a range of policy areas, that gives you an indication of what might happen here. But aviation is not an isolated case. It does fit into a broader pattern of transatlantic tension over regulatory reach and overreach. On the business side, airlines are already mobilizing against any extension to non EU flights. And the argument they'll make is twofold. Firstly, that applying EU carbon costs to routes that go beyond EU airspace is an extraterritorial overreach. The EU is effectively regulating activity taking place outside its jurisdiction. But secondly, that it also puts European carriers at a competitive disadvantage relative to airlines that are not subject to the same costs on the same routes. Airlines, and particularly those with a lot of long haul operations, are going to argue strongly that CORSIA provides an adequate international framework, and duplicating it with ETS obligations is both unnecessary and commercially damaging. The Commission decision will be as much political as it is technical.
Staying international, James, you are sitting in London, so I have to ask that question. The linkage of the EU ETS and the UK ETS, where does that stand?
Well, we're recording this days after potential new prime minister news. So all of this is subject to where things go politically in the UK. But it is one of the more closely watched developments in the carbon market space right now, certainly in the UK. At the summit in May 2025, the EU and the UK were committed to working towards linking their respective emissions trading schemes. They set themselves an ambitious target of reaching an agreement before the next summit, which has now been postponed. So let's see where things get to by then. But in any case, the political sensitivity here is real. As we saw with the links with the UK and the EU ETS systems many years ago, linking the two systems would in practice require the UK to align closely with EU rules on a cap, on allowance design, on market oversight mechanisms. That regulatory alignment, following the recent 10-year anniversary of the Brexit vote, is not straightforward to sell domestically. And at the same time, the economic logic of linkage is compelling, and both sides appear genuinely motivated to make it work.
What would a potential linkage mean in practice for businesses?
In the most direct sense, it would mean carbon price convergence. So, right now, the EU and UK carbon prices can diverge, and that divergence creates both uncertainty and potential arbitrage for businesses with operations across both markets. But a linked market removes that arbitrage opportunity and brings a degree of simplicity and predictability that businesses generally welcome. And not to forget, if the systems are fully linked, imports from the UK into the EU could be exempted from CBAM, and that could possibly have a positive effect on trade flows. There's also a related point around carbon storage linkages. We saw one of the first London Protocol agreements signed between the UK and Belgium last week. An effective integration of carbon storage regimes also looks like a logical move alongside this alignment of emissions regulation.
I think we've covered now a lot of ground on where this revision is heading. To both of you, what do you think should businesses now actually do with all of this information?
Well, if you ask me, the starting point is don't wait for the final legislation. I know that runs against the instinct of most legal and compliance functions, which are trained to respond to law, not to anticipate it. But first, the policy process is where decisions actually get made. None of what we discussed is set in stone. And the most effective advocacy strategy is to engage with the Commission ahead of the publication of the proposal. And it is worth being concrete in that engagement. Policymakers are not looking for general statements of concern. They're looking for evidence, data, and specific proposals. Companies that come with well-substantiated positions tend to have far more impact than those that simply express opposition. And second, tomorrow's strategy needs to be developed today. You need to be prepared and develop strategies. In my view, waiting for the final legislation before deciding how to respond is simply not an option.
And for clients who want to get ahead of this internally, James, what would you say does good preparation look like?
For companies that are exposed to the EU ETS, the first step is just to make sure you've got a clear picture of your own position under different regulatory outcomes, because the range of scenarios here is genuinely quite wide. What does your cost structure look like if free allocation conditionality tightens significantly? What happens to your capital and operational expenditure plan if carbon price moves slower than foreseen? And also critically, how does your position compare to your competitors, both within the EU and globally, under all of these scenarios? And that kind of scenario-based assessment does several things. It tells you where your real exposure lies, which may not be where you currently assume it is. It gives you the foundation for a much more informed engagement with the policy process, because you can articulate specifically which design choices matter most to your business and why. And it gives you the analytical framework to stress test investment decisions, so management can understand the range of risks and rewards behind investment opportunities. But beyond the numbers, it's also worth making sure the right people inside the organization are engaged. EU ETS strategy touches legal, finance, operations, government affairs, and more. And in our experience, companies that have joined up thinking across these functions end up being significantly better positioned than those where EU ETS is treated purely as a compliance matter that sits within one team. The decisions that have to be made now are increasingly strategic and in some cases existential, and they deserve to be treated as such.
James, Stefan, I think that has been a very substantive conversation. I think we can conclude that the EU ETS revision is not just a minor regulatory adjustment. It is a fundamental redesign of a system that has been running for 20 years. The revision or the result of the revision is going to touch on investment decisions, cost structures, and competitive positioning across a wide range of industries. Again, the Commission's proposal is expected for 15th of July. The legislative procedure is targeted to conclude by early 2027. And clearly, the window to influence the outcome of this revision starts now. If any of this raises questions for your businesses, we at Freshfields would be very glad to help you think it through. Many thanks to you, James and Stefan, for your insights, and many thanks to all of those that have been listening. If you found today's episode useful, please share it with your colleagues and networks. Thank you very much, and see you next time.